Hello and welcome to this Markets Today special. I'm Udayan Mukherjee. It's the start of the year and it's a great time to talk to some seasoned experts from the street on how this year is shaping up. Sanjeev Prasad of Kotak Institutional Research is really an old hand in the markets and he joins me now on the show. Sanjeev, great to see you after a long time. It's a tricky year to call, but there is almost a consensus view emerging that the first half will be bad and the second half will be better. And markets usually don't respect consensus. Do you think a surprise or two could be in store?
Well, I'm not too sure whether it will be really bad in that sense. I suspect the market will not do much in the first half. That's how I would look at it. And hopefully the second half, as valuation becomes slightly more reasonable based on roll forward of earnings, hopefully maybe the market start performing. So let me just elaborate a little bit. So if you look at currently where we are in terms of the growth part, it's a mixed picture as far as the economy is concerned. We are seeing maybe some pickup as far as the basic or staples consumption is concerned, but clearly seeing a big slowdown on the discretionary part of the reason for that, which we can talk about later. If you look at the investment part, again, a mixed picture in the sense, housing is doing very well. That is the household part. Private sector capex, bits and pieces, things are picking up, but I think the big pickup should only happen from next year, looks like to me. And government capex, will be under through linked to the government's fiscal capacity to spend. So mixed picture, I would say, in the sense, we will do about 5.5% GDP growth for FY24, which is quite decent in the global context. If you look at on the interest rate inflation part, again, we are in a situation where I don't see major headwinds or tailwinds to the market from interest rates. In the sense, inflation has peaked both globally and in India. I don't see any necessity for the RBI to be raising rates meaningfully from where we are, and essentially inflation will decline quite sharply going forward. Having said that, core inflation is still sticky, and it is sticky everywhere in the world, which means the central banks will not be in a big hurry to cut rates also at the same time. So I don't see any, great positive or negative news from the interest rate part also. So I suspect given where we are on the growth part, where we are on the interest rate cycle, looks like we just meander through for the first half. And of course, valuations are still punchy as far as India is concerned. So my hope is, probably you see some time correction, and the market already has seen a fair bit of time correction. If you look at the last 12, 15 months, the market hasn't really done much. So I suspect probably the same pattern repeat for the first 6 months. After that, we'll see, depending on how things pan out, and hopefully valuations start to be more reasonable, as I was saying, based on more forward earnings. Hopefully, the market start performing on an absolute basis then.
Do you see the budget as any kind of a trigger at all, Sanjeev? Because once again, there is all this talk about long-term capital gains tax and whether it will come or not, but that happens before every budget. Other than that, do you think the budget is a deciding factor at all?
See, the good thing, Udayan, is that we don't have to, wait for the budget for the government to make any policy announcements. Historically, there was always a lot of expectation around budget, but I think this government at least has moved on from making announcements only on one particular day. And there are also 364 days in the rest of the year, right? So you can do all the policy work on those days too. So I don't know, honestly, what to really expect over here in the sense, now the budget has been more reduced to a presentation of the government vision, which is fine, more medium to long-term view of the economy, as also presentation of the government's, accounts in the revenue expenditure part. Now, if you look at where we are in terms of the fiscal numbers, clearly it's a challenge position. This year, that is March 23, consolidated fiscal deficit will be somewhere about 9.1% or so. Central fiscal deficit will be about 6.4%. For FY24, we are currently projecting 8.5% consolidated, about 5.8% for the central level. So there could be some consolidation from the government side, but I would assume at the same time, the government will still have some ammunition, for the market in terms of extra spending on agri and rural, as also the infra part. So which will probably, create some excitement in the market, hopefully. But having said that, given the government fiscal position, I don't see a big increase in spending at the same time. And really looking at the fact that the government has committed to fiscal consolidation in the medium term, we have to go down to 4.6% or 4.5% by FY26. We have to start fiscal consolidation in the next financial year itself, that is FY 2024. On the other parts, again, taxation. Anyway, indirect taxes out of the purview of the budget now. It's the GST is anyway part of the GST. Council. Direct taxes, most of the heavy lifting has been done, to be honest with you. The government doesn't need to do much over here. Hopefully, you see some more positive announcements on the disinvestment front, and the government can always do put more revenues, if it needs to spend incrementally on the rural or agri part. On the capital gains tax part, who knows, Udayan, to be honest with you, there's always this expectation that the government will do some tinkering in the budget. But having said that, the government's long-term policy is to have uniform policy across all forms of asset classes, whether it is debt or equities, real estate, jewelry, etc. And you have a fairly complex capital gains tax regime as of now in the country. So I won't be too surprised if you see the first steps of normalization. I hope it's not a big change suddenly, and it could be both respect to the time and the rate also, in the sense, remember in case of equities, it's actually 1 year, the time for demarcation between short term and long term. So I don't know whether the first step will be, increase it from 1 to 2. Keep in mind the fact that debt is actually 3 years, so maybe that's the first starting point, rather than a big increase in the capital gains tax rate itself. But let's see, how this unfolds.
If the government says that we will not touch the tax rate right now, but we bring it at par with debt by making long terms the definition 1 to 3 years, do you think that will be a jolt for the market?
Yeah, I would think so, because I don't think the market is prepared for 3 years at least. So there's some expectation of 2 years. But 3 years would be a bit too much to start with. But having said that, I still think people would look at India from a more medium to long term perspective. Most of the investors are, fairly long term oriented. Do we need this at this point in time? The answer obviously no. Maybe the market never wants such a thing, right? So let's see what the government does. A small step is okay, I think. A big one would be a negative thing for the market.
Before I talk about the market, Sanjeev, I want to ask you about your stance on financials, private sector financials at this point, because you've seen a couple of numbers, Bajaj Finance first, which created a bit of flutter, and then ICICI Bank. Are you comfortable keeping your overweight stance on financials, or would you want to change it in any way?
No, then as of now, we are quite okay with it in the sense, both on an absolute basis and relative basis, the financial sector looks okay. So on an absolute basis, if you look at the valuations of the tier one banks, most of them are actually quite reasonable. Look at an ICICI Bank, for example, or an HDFC Bank, both of them would be trading at about 2.4 times March 24 book, adjusted for the value of their non-banking businesses. So look quite okay. If you look at, let's say, an Axis or an IndusInd, Axis about 2 times 1 year forward, so IndusInd about 1.6 times. So in fact, I think there's still probably some scope relating as far as the next lot of tier one banks are concerned. That is an Axis or an IndusInd. If you look at let's say the tier two banks, you put all the PSU banks over there, some of the smaller private banks, I think valuation are very reasonable. SBI is about 1.2 times, again, 12-month forward basis. Most of the other PSU banks are, one time, that is Bob, and others are actually lower than 1 time price to book. So I don't see too much of an issue on valuation to start with. And more important, at least the next 2 years, we don't see, any signs of credit quality deterioration that we're not aware of as of now. So credit quality should not be an issue. Credit growth is picking up. So if I put everything together, the banking sector does look quite okay on an absolute basis. Yes, of course, you will see some pressure on NIMs going forward over the next 2-3 quarters, but that's expected. Obviously, you had a big tailwind in the form of expansion NIMs, given the lead lag effect of increase in lending and borrowing rates. But I don't think anybody expecting that this kind of NIM lasts forever. So, most analysts would have built that into their models anyway. Coming to on the relative argument, if you look at the other growth names, they're still pricey. In the sense, if you compare their valuations with, let's say, the March 2019 valuations, when the interest rate were exactly the same. Look at the policy rate, currently 6.25. March 19, it was also 6.25. So if you adjust for the interest rate part, most of the growth names in consumption, investment, even outsourcing, are still trading at significantly above the March 19 valuations. So that makes me a bit nervous that, you could still see some derating in that part of the market. Banks look fine. In the context of the valuation, they're still actually lower than the March 19 levels, and the fundamentals are pretty strong at this point of time. So yeah, so banks will look okay. Having said that, banks are always vulnerable to any external shocks, given the high leverage to always sit on. Very bad macro news, either globally or domestically, banks would be the first to correct and correct quite significantly. So that's the only caveat I would make over here.
The surprise pack or the big outperformer last year were the Adani Group stocks, Sanjeev. I want to ask if you have any of those group stocks under coverage and what the stances or reported stances are.
No, we don't cover any of them as it the free float is still too low. Hopefully, once you see the issuance of Adani Enterprises, you start seeing more interest from the investors also, and hopefully, that's when we start looking at more active coverage of the group. I mean, we anyway cover Adani ports. Obviously, Ambuja Cements, Ambuja Cement and ACC we have covered for a long time. So they're all Adani Group companies anyway now. So let's see. As the free float of these companies improves, hopefully you will start seeing more interest from investors.
What's your clear underweight call for 2023, this calendar year? What are the sectors that you're avoiding?
So as of now, largely on the discretionary side. So that includes automobiles, barring a few names here and there. A large section of the consumer durables pack. And my concern over there is both a combination of shorter-term slowdown, which is probably not factored into analyst numbers. When I look at consensus numbers, they still look very, very high to me. So you'll probably see some downgrades, which means the multiples are actually even higher than what we are looking at currently. The multiples are high to start with. They're significantly higher than pre-COVID levels. And assuming our thesis is correct of finding downgrades, then the multiples are actually even higher than what the street is building in currently. So that's one big risk in the shorter term. Also in the medium term, starting to get a bit concerned about I don't know it's the business models of these companies, but many of these companies had fantastic moats, and that's one of the reasons why investors have been willing to give very high multiples for these stocks. But of late, what we are seeing is some cracks starting to emerge in the business models, business modes that people thought were completely unbreachable. Some investors have started to have rethink. That could result in some amount of derating in the multiples as we go forward. I mean, that's not going to happen immediately, but I think over the next 1 to 3 years time frame, some of those factors to start playing out. So you have a combination of very high multiples, B, possible earning downgrades in the short term, and C, concerns around business models emerging more in the medium term. I would be a bit skeptical of that sector for the time being.
Overall, do you see any kind of major risk for earnings downgrades through the year over the next 2 or 3 quarters as we roll forward, which might come as a surprise to the market, which is already priced quite perfectly?
More on the discretionary side of there. Otherwise, we are quite okay. Of course, the commodity basket does have a fairly large weight in the Nifty 50 index. You don't know, where commodities could end up eventually. But all said and done, if I look at the bigger sectors, banks, I don't see too much of an issue. Consumer staples should be fine, given we are quite hopeful about recovery in consumption of the lower-income household, which should support consumption of staples. Utilities would be fine anyway. Maybe you see some downgrades in autos. Telecom, if you don't see any further ARPU or tariff increases. Little bit maybe on the cement side. But broadly, I think we're okay for now.
Have you changed your stance in any of the digital stocks, the Nykas and Zomatos of the world after the price correction over the last few months?
Yeah, analysts always had a positive call on them in the sense, these are good long-term stories. Obviously, stocks have corrected a lot more than what we had thought they would. We never had very high, let's say, target prices compared to where the stocks were trading at. But some of the correction has surprised us, I would say, especially the way Nykaa has corrected over the last 1 month or so. That's been a little bit of a negative surprise, I would say.
Are there any governance issues out there, Sanjeev, other than the earnings, cash flow, those kind of concerns which have been around? Do you think some of the corporate action of the last few months has created some kind of disillusionment?
We're talking about the new tech companies.
New tech companies specifically, the bonus issues, etc.
Look, I don't want to comment on specific issues, but yeah, some of these things would have been handled better. If the company is doing acquisitions, it's best, to come with, a very clear rationale as to why this acquisition will be done and how does it, fit into the company's, that's a core business model. Yeah, so I don't want to really get into specifics over here, but yeah, some of these issues could have been handled better, I guess.
Do you see any opportunity in mid-cap IT right now? Because there the valuations were very excessive at the start of 2022, but they have corrected quite meaningfully. Are they better now, or are they attractive now, or do you see more price compression there?
No, then at this point in time, we'll stick with the large caps. Anyway, we have an underweight call on the overall sector to start with. We're still not very clear, how bad is the situation in the US, in the sense it's a small slowdown, a big slowdown, a shallow recession, a deep recession, only time will tell. So as of now, what is getting factored in is in a small slowdown, which we don't know for sure whether that's the end game of how things will pan out in the US. If it's anything, deeper than that in terms of a slowdown or a contraction in the US economy, I think the repercussions on the IT sector will also be quite significant. So in that context, best to stick with the larger ones. You're already starting to see, a number of the bigger IT companies in the US starting to lay off workers. So that's not a good sign. So clearly, there's some consolidation starting to take place among the client itself, in the sense they will probably start consolidating their set of vendors, and that's definitely not going to be positive for the smaller ones. So if let's say a Walmart, and just to give a name over here, is looking at reducing number of vendors, just focusing on the top 3-4 ones. I suppose some of the tail ones could get cut out, and that's where the risk could be for some of the smaller IT names, that they could be lost in this vendor consolidation process.
What are the chances that we have a double-digit return from equities this year, Sanjeev? Because we are in a situation where a lot of high net worth investors are saying, I can get 7-8% now in fixed income, fixed deposit with very little risk. Do I need to be in equities? What would you say to that kind of proposition or assertion?
Looks low, I would say, the probability at this point in time. The key thing would be, if you see a big pivot from the central banks toward the middle of the year, end of the year, which can, provide a big tailwind for the market. That's clearly not factored in, because as of now, the consensus view seems to be that you will see a small pivot from the US Fed towards the end of this year. Now, how quickly that starts getting factored in the market, the only time will tell. But at this point in time, the expectation is, since inflation is still on the higher side, it's coming down, but gradually. And core inflation is still sticky. Most central banks will probably keep rates, at whatever the peak rate, at that high plateau for a longish period of time. And if that is the case, probably you don't see, any great tailwind from the interest rate cut part. But yeah, that's the only thing which I can see, which can be a big positive for the market, because I don't see any scope for earnings upgrades in a short period of time. Very unlikely, I would say, that suddenly, the world goes from factoring in a slowdown to, to a big revival, which results in earnings upgrades. I don't think that is happening. So the positive surprise, if anything, has to come from the interest rate part, I would say.
Hey, great talking to you, Sanjeev, as always. Thank you very much for your time today.
My pleasure entirely.
If you like the video, do like, comment, share, and subscribe.